Alright, let's dive into what's happening in the markets right now because, honestly, it's a wild ride. The big headline: the ASX is set to jump, and Wall Street just had a monster day, thanks largely to Microsoft. But here's the thing, it's not just about the numbers. What makes this really interesting is why Microsoft is leading the charge. Their stock leaped 15.5%, the best day in nearly 18 years, and it's all because their AI investments are finally paying off. Personally, I think this is a huge deal. It's not just about Microsoft, it's about the broader narrative of AI. For months, there's been this lingering question: is all this spending on AI actually worth it? Microsoft's results suggest it might be, but here's the kicker: they didn't announce a massive increase in AI spending like some of their rivals. That's a smart move, in my opinion. It shows they are balancing ambition with caution, which is something a lot of companies could learn from. Now, let's talk about Apple. Their iPhone sales surged 21.7%, hitting $54.25 billion. That's insane, right? But what many people don't realize is that this isn't just about people buying more iPhones. It's about pricing power. Apple raised prices across the board, and customers still bought in. If you take a step back and think about it, this says a lot about consumer behavior in a high-inflation environment. People are willing to pay more for premium products, which is a fascinating insight into where the economy might be headed. But here's where it gets even more intriguing. While Microsoft and Apple are celebrating, Meta Platforms took an 8% hit. Why? Their profit was weaker than expected, and they are ramping up spending. This raises a deeper question: are we seeing a shift in the tech landscape? Microsoft and Apple are thriving by focusing on AI and premium products, while Meta's ad-driven model seems to be struggling. From my perspective, this could be the beginning of a bigger trend where companies that adapt to new technologies and consumer demands win, while those stuck in old models fall behind. Now, let's zoom out to the bond market because it's a whole different story. Treasury yields are holding steady, but there's this underlying worry about inflation. The Fed's Kevin Warsh didn't give much clarity on interest rates, which has investors on edge. Personally, I think the bond market is the elephant in the room here. If inflation stays high, it could force the Fed's hand, and that would have massive implications for stocks. What this really suggests is that we're in a delicate balance: one wrong move, and things could unravel. Finally, let's talk about the global picture. The Kospi in South Korea is down 34% in July, largely because of Samsung's underwhelming earnings. A detail I find fascinating is how much the Kospi is influenced by just two companies, Samsung and SK Hynix. It's a reminder of how concentrated risk can be in certain markets. Meanwhile, oil prices are easing, but the Middle East tensions are still a wildcard. If you ask me, this is the kind of volatility that keeps investors up at night. So, what's the big takeaway here? In my opinion, we're at a crossroads. On one hand, you have companies like Microsoft and Apple proving that innovation and adaptability pay off. On the other, you have inflation, geopolitical tensions, and a Fed that's walking a tightrope. It's a fascinating time to be watching the markets, and I can't wait to see how this all plays out. What do you think? Are we on the brink of a new era, or is this just another bump in the road? Let me know in the comments below.